Good morning. Welcome to the Brew Traders Workshop edition on Thursday morning. You know the rules. Today we're going to have Mark and Jason, and the show is all about the NVDA earnings that just were released last night. So let's get to it. There's a lot to talk about today. Good morning.
Good morning, Lex. You're getting good at this cold open, man. Like you've got a future in broadcasting.
Oh my God! Yes, after you do it so many times. And we have a good one today, though. This is an easy one in terms of the cold opening. We're talking about NVIDIA, fresh off the press, right? The earnings. So I know we have a lot to talk about. Jason's got some Voland. Mark and I are going to debate a couple of concepts about implied volatility. Jason's going to correct us where we're wrong and right. We're going to talk about straddles and strangles, premium. There's all kinds of things to run through today. What else, Mark? What am I missing from the trader end of it?
I think that's all good. I mean, we can talk about how we think about earnings expectations, how to model them, what to think about going into them, how vol environments impact that.
Yeah, I think, see, we didn't have vol.land back in the day or Harvested Financial to help us out. We had this little thing that we did like that, like one of those we did. So that's what we did. But we did have mathematics, so we could figure that out. We're going to talk about that too. Let me run through the earnings report. Jason, how are you? Sorry, I didn't give you a chance to say.
Oh, I'm doing okay. Yeah, just, I recently visited the CBOE floor, and it seems like still people are,
You're doing that? Yeah.
Just a little bit. Just a little bit. They have people on the outside saying, but yeah, it's still a little bit of that. And, but back, I guess, when you were working, Lex, your quant was who? Copernicus?
It was Copernicus, yes. The Earth was still flat, by the way, I think, back then.
Black-Scholes certainly was.
Black-Scholes certainly was. That's all we knew, by the way, Black-Scholes. I don't think we had Cox-Rubenstein then. I don't think that came out. Man, I could be wrong about that, but I think we were all around Black-Scholes, right? Back then. Well, it's way before you guys. So anyway.
Well, and CRR is basically Black-Scholes across a bunch of different trees.
Yeah, that's true.
It's really just builds on the original model.
That one's better for non-European, I think, the Cox-Rubenstein, right? The CRR.
Exactly, because you can model all the probabilities of the early exercise.
Yeah. Did you notice, before we get into this, did you notice my haircut?
I mean, in 4K, how can you not?
In 4K, how can you not? That's good. That's a good point. All right, cool. All right,
you got to get them while you still can.
That's right.
You got to get the haircuts while you still can.
He's making fun of my lack of hair. I think there's a hair joke. All right, here's what I got for the earnings. So it looks like NVIDIA reported adjusted earnings of $2.70 a share, beating the analyst expectations of $2.09. That's quite a beat. Revenue was $13.5 billion, and the analyst expectations were around $11.25 billion. So this was a monster, and is what it looks like. So there's
between friends.
What's that?
It's just a couple billion between friends.
Yeah, right. Who's
only off by like 2?
Wow. I'm just reading through this real quickly. This is insane. It was like a 171% year over year revenue growth. So that's just monster. So I'm surprised the stock's not up more, quite frankly. What am I missing with this thing? So anyhow, that's a big deal.
4x in the last year already. So
yeah,
right. Yeah, that's true. That's a good point. So a couple things. I want to talk a little bit about, Jason, your expectation with Voland, and also some of the ideas that we have going into the earnings around straddles and an expected move. Would we buy the straddle? Would we sell the straddle, et cetera? So let's start, Jason. You had a look at Vana and your analysis from your vol.land website. Is that right?
Yep.
All right, let's pull it up. Here we go. What is this showing? Tell us about this.
This is NVIDIA's Vana for like the next 2 or 3 expirations. Mainly, a lot of it was obviously this Friday, preparing for earnings. And you could see the price was down to about 470 or so. So this was 2 days ago. I think not yesterday, or I guess it's 3 days ago. 2 days ago, it dropped quite a bit. Yesterday, it rallied a little bit. And then today, I guess now we're at 500, 525. And typically on my site for subs anyway, I do earnings reports, and it's a Volland report kind of showing what the lay of the land is in Volland. And I also use our good buddy Matt Amberson's ORATs, who has a very robust earnings.
Hold on. Did you say ORATs? That's a plug. That's a plug. Hold on.
It's an unsold plug. I am not getting I'm not getting reimbursed in any way for that. But
we gave Matt a plug. Great guy, great piece of software. But anyway, go ahead. Sorry.
Yeah. Anyway, but NVIDIA is one of those stocks, like I guess you could say the Mag 7 that they're calling them now. It's one of those that options control a lot of the movement. There's a lot of traffic. I think like it's like the 3rd or 4th largest single equity option traffic out of anything that the options are offering.
Second, number 2 after only Tesla.
Oh, is that right?
Is it really? Because I thought Apple was.
No, recently NVIDIA's been trading a lot more. I think I've been looking at the last 90 days.
Oh, wow. Okay. So yeah, there you go. Now it's number 2. Like I tend to look at like years behind, and so all right. So within the last 90 days, it's number 2. So the first thing I always look at is Volland in that kind of scenario, and Vanna is the reaction of market makers for every point move in implied volatility. So if you see positive Vanna and implied volatility is going down, then so are the dealers' deltas, and that means they have to buy in order to hedge. With something like earnings or Jackson Hole speech or anything like that, there is always some extra implied volatility built in because there's an event that will cause volatility. And after that event, typically implied volatility, that event vol comes down. And if you can see the Vanna landscape, then you can get a good read on how declining implied volatility will affect the stock. Now, this doesn't mean that every single time you see positive Vanna, that means that the stock will go up after earnings. Earnings have to be at least neutral in order for that to happen. So I guess like 3 days ago, I was asked to look at NVIDIA, and I saw these 2 huge Vanna spikes, and that is at 500 and at 525. Okay. And so when you approach a strike with a lot of Vanna, positive or negative, it becomes neutral. And so what dealers would have to do if event vol comes down is they would have to buy until they're hedged for all this Vanna that they're going to have to deal with. These are covered calls, by the way. So somebody sold a lot of calls here in NVIDIA and did not buy a lot of puts. You could see underneath there's not a lot of
to the downside buying. Down below.
Yeah, down below price. There was not a lot of put buying. So I guess people wanted to hold on to their shares no matter what. So I guess back then I said that NVIDIA will probably get up to 500, 525 in that area because of these 2 large Vanna spikes. And now here we are after earnings, event vol dropping down, and we're opening up near 500. And we can even advance a little bit more to get closer to that 525 area.
So what do you see happening in a situation like this if, totally the positions people have on make sense, overwriting, like plug, that's what I would do in this situation, also not financial advice, but like if you have a bunch of like overwriters in here and all of a sudden say NVIDIA comes in, everyone's over expecting, right? Like you got to imagine one of these next earnings, everyone's over expecting. Like what if they miss by 2 billion? Like what is, like obviously we're going to see the same deflating vol comes out with the event, yada yada. But how would that play in a miss scenario?
So if it misses enough and the price goes down, the farther you get away from these strikes, the less Vanna becomes. So it can actually get neutralized if, you miss and it goes down to 400, or even, like 415 or something, those two towers will shrink. And dealers, I guess you could say, would have been hedged fine for it.
Yeah.
Event vol still will come down, and fundamentals do rule the day for earnings. I mean, you can't get away from that.
Right.
Earnings are going to, affect what the price is. But overall, though, like, it's either that we go up to those Vanna strikes, or in this particular case, with no puts purchased, it really can go down. It could have gone down, but far enough for Vanna to disappear.
Yeah. So the Vanna disappears. That also means that, there's not a big gamma cluster down below either. Right.
That's right.
So dealers are not going to have much of a push or pull to the downside here. So they're fairly neutral down there. So you never know what could happen on a bad miss with a move with nothing going on down there. It could just kind of be in a vacuum and say, "Whoo-hoo, here we come!" Right?
Well, probably what would happen is people would buy puts like crazy because they weren't expecting a downturn. They are likely long shares, hence why there's overwritten calls on there.
Yeah. Right.
So they're probably long shares. They see something go down, and they're like, "Uh-oh," and then they start buying puts, and that'll make things worse.
All right, I'll put you on the spot, both of you. You ready? This is not investment advice. Okay. Knowing what you knew relative to, and we're going to talk about implied volatility in a second and expected move. Know what you know about all that stuff and the vol and chart, and mark whatever you like to look at with the harvested. And maybe there's some put call ratios and some skew there. What's the position you like to have on in NVIDIA if you're trading this stock? What would you guys have done prior to earnings, if anything? The answer might be nothing. I stay away from it, but I hope it's not that. What do you do? What's your favorite spread here?
Mark, I think it's time for you to cue in implied volatility and expected moves.
Well, I don't want to disappoint you, Lex, but I feel like from a retail perspective, the best time to get involved in earnings is right after. That in a lot of ways that, like, I think going into it, there's a lot going on, right? Those are always some of the most active volume days. People are definitely speculating on it, but there's a lot of really good pricing going on out there. To plug Matt's implied move reports again, like, it's amazing how well straddles get priced in options these days. I remember a decade ago, there was a shop that was incredibly crafty at trading these, and they stopped doing it because there wasn't edge in there anymore. So I think in terms of like a pre-earnings move, my play is to stay away, because to steal like a Charlie Mungerism, that's like the short-term voting machine of the market. Whereas if I want to make a play, I want to lean on the weighing machine of the market in the medium and long term. So I don't want to deal with like the jerky earnings reaction that's just going to be, swamping liquidity this way or that way and, immediate knee-jerk reactions. I'd rather look at the setup that's given to me now with this news and let the market digest that for another 30 to 90 days and put on a play given that.
Even with the absolute expectation of a vol collapse, right? It has to happen after earnings. You're okay with that? You don't want to grab some high vol in the interim? Too much of a binary move in play?
No, and I think actually like NVIDIA is one of those situations, and I think this goes to Jason's overwriting point. Like, the upside is incredibly bid. Like, there are definitely a lot of a lot of people betting on this going up too, right? Like, I think there's heavy action in the upside calls. And if you look at the skew, they're very that's tilted. So to me, that says the risk reward here is be long shares, sell like a 15% out of the money call, and you can get that 5-20% put spread, right? So to answer your spread question, I like the seagull here, where I'm like covered 5-20% on the downside. And right now you can sell at 90 days, like a 15% out of the money put. So you can sell like the 550 or something like that right now, depending, it'll obviously settle once the market's open. Yep. But I like that upside downside risk reward here.
Okay. That's interesting. Yeah. I didn't look at how steep that skew was.
If you want to share the screen, I've got one queued up.
Yep. Let's do it. So that's perfect. Go ahead. Sorry.
So yeah, this is at 90 days, which is that's the tenor I usually like for like a seagull type strategy. Yep. I think 30 is a little short. But looking at the 90 days here, like these 30-20 delta calls, like those are pretty bid up. And so you can actually get some real decent premiums. And so like what I have here with the gull, the light yellow line yeah, it's like 19% as of yesterday. That'll come in a little bit, but still getting 16% out of the money at 90 days to protect your 20% downside, like that feels like a pretty good trade-off here,
Yeah.
risk reward wise.
Just so we're clear, I know this is probably a little heady. The goal, explain the goal again. I know we've done it a number of times, but just for today, relative to explain what the spread is and what we're looking at and how you're analyzing it.
Totally. So first of all, I have to apologize. There's obviously a bad data point in there at some point, and that spike down in June 15th or whatever that is. I'll get that cleaned up. But yeah, what this tracks is the percent out of the money call you can sell cash neutral against buying the 20% out of the money put spread.
Okay.
So how expensive is that put spread in terms of upside calls?
Got it.
So how much upside do you give away to get that downside protection?
So in a case like NVIDIA, you can go way up and get great value to offset that put spread down below because it's bid up pretty high to the upside. Is that right?
Correct. And this is even, we're looking at 90 days, right? There's not much earnings like juice in that 90-day value, right? Like there's might even be another earnings event if the thing's timed right. So like the 90 days, like it's going to come in a little bit, but we're not going to see that crush that much here.
Yeah. Okay. Is there a, like in your mind, again, not holding you this is your opinion. Is there a kick point that makes it like a juicy trade? Meaning, and what I mean by that is, if you want to protect 5% to the downside, if you get 10% higher to the upside, is that monster? 15%? Is there a number that's just like, this is unreal, this is way too good to be true?
You know, I think that's where you have to blend like the art and the science of like position taking and really have your like, and it, like, right, we're as a buy side trader, I don't mean like buying options, but bringing order flow to the market, like a liquidity taker, like you need to have a thesis and an edge that's like different from the market. And so like in this scenario, I think your edge has to be finding a scenario where you think the up down is better than what the high vol is pricing, right? Because this ratio is going to go up if vol goes up, right? So like if you have 150 vol stock, yeah, you're going to be able to sell a far out of the money, but 20% protection isn't going to mean a lot, you know?
Sure.
So like, I think it's really dependent on the name. And, you know, that's where I like to lay a kind of qualitative narrative on top of this, right? Are people going to FOMO into the stock now that it's had like another thing? Is this going to pick up some memeability? Like we see that in the skew, like that to me is probably a better indicator of where I like to say, that upside call is expensive now.
Got it. Okay, that's interesting. So what I want to do is let's have a look at what we were at yesterday. I might have to share a different screen, so give me a second. Because I looked at implied volatility yesterday, and I think it was about 165, you know, toward the end of the day. And it could have been 185, it could have been 200, it could have been 150, but I chose 165, okay? So what I'm going to do is I'm going to show you what I have here. Holy cow. All right. So this was yesterday. I put the straddle in. Okay. So it's the expiring August nearest term. So it's 1 day to go, which is tomorrow. Right. I chose the 470. That's where the stock was trading last night, about 471. It comes out to be about $45. Right. That straddle. Now, we can debate what that means. Now, as a rule of thumb, a quick thumbnail, that's about the expected move, right, of this stock based on this binary earnings event. About $45 is what the community's pricing in. So does that sound cool so far?
Sure.
Okay. Now, on the other hand, we'll go into the remarkable. If you compute expected move using the handy dandy formula for expected move with implied volatilities, we have a $471 stock, right, which is this value here, and then we have a $1.65, which is 165 in volatility terms, and then we divide by the square root of time, and we use 16 as the rule of thumb, I think, right, Mark? I did it exactly to 15.87. We come out with a value of $49, which is the expected move based on the implied volatility of that at the money straddle is what I used. So I'm not sure there's an answer here, but why the difference between what the straddle is pricing at 45 and the actual mathematics of 49? I know it's not a lot. I guess it is a lot. It's $4, right? Roughly. Is there an answer, Jason? You're going to be Mr. Math here, I think. But what do you guys think about this?
So, as we were discussing before the show, or I think even in the beginning of the show, back when Black and Scholes were sitting next to Lex, that was the only model out there. I mean, and when you had only one model, you had implied volatility. It wasn't, and everybody based on that one model. Nowadays, you have like 4 or 5. You have like Burstrand, you have Binomial, you have Black Scholes, you have Black Scholes Merton, you have, and so there's a bunch of different models that you could use. So the community is an amalgam of all of those models put together to make a $45 straddle. Meanwhile, the implied volatility that you have there in TradeHawk is based on some model, like probably a single model, and that's the one, there's probably somebody out there who's using that model saying, oh, implied volatility is overpriced. We're going to sell these options.
Okay. Any thoughts on that, Mark? About similar? I think he summed that up. And there's a whole bunch of, if we talk about skew, that's all computed in that implied volatility. So it's part of the equation anyhow.
Yeah. And I think like maybe an interesting thing from like a trader's perspective is like, to Jason's point, like if vol is high on your model and the market's like pricing it low, that doesn't mean like an auto buy, or the market's pricing it high and your model says it's low. That doesn't mean it's like an auto sell. That like, it's really important when you're thinking about those levels that you like maintain either a consistent model or like a consistent comparison, that like comparing across different types and assumptions is going to get you into a lot of hot water fast.
Yeah. Okay. What do you do with this? T-1, we're trading, we're down there on the floor days. What's your preference on this implied volatility? We know there's going to be a big move, right? And we know that we've traded these a million times in our career, right? These earnings plays, which I personally, I did not like trading these. I will say that straight out. I actually hated trading these. What do you think, Mark?
I totally agree. I mean, it's worse than opening a case of like 50-year-old wine where half the bottles are corked, right? Like it's just a total Russian roulette, the way these things are going to work. And so, I mean, I think to put a little bit of science behind it, like one of the tricks we used to use to adjust sort of for expectations is you look at how much it moved in the past. You looked at what the average vol environments during that time, right? Like if it's a $50 stock and it moves 5% when the VIX is 20, that's different than a $50 stock that moves 5% when the VIX is 10. Yeah. So you have to like take sort of that move and relative like vol regime into account. So we used to do some like just rough bucketing on those things, but we would never take positions one way or the other. It was more to understand the dimensions of it and let the order flow take it, right? Like you just got to be nimble and not have a bias and make sure you're pricing it in well, because
I think that's right.
Well, I would figure, and again, I was never on the floor with you guys, but I would figure if I were there, I would want to widen my spreads because you are a victim of adverse selection. So, if you could sit there and look at all what happened in the past all you want, but if a bunch of people know that NVIDIA is going to go up or something like that, then, you're stuck with things. So don't you have to like maybe increase premium or widen spreads or somehow be compensated for that adverse selection risk?
I definitely like, as a liquidity provider, you're always subject to adverse selection.
Right.
But it's a tough gambit, right? Because there's so much more volume going into earnings that if you widen your spreads, you're not going to trade, and your business is trading. So you need to get in there and you need to like be active and just be really quick to adjust your pricing, right? Like we always found that it was better to adjust price than adjust size and get cute with stuff like, oh, I'm 10 up on the bid and 50 on the offer. It's like, no, if you want to sell, move price. Like that is how you sell vol.
Right. Right. Now the other part of the equation is, and I agree with you, Mark, how we handle ourselves in these situations, these high vol. We tried to be as flat and neutral as we could possibly be in that high month, right? I would, you're always enticed to say, Well, implied vol in the front month's 165, and 2 months out it's trading 68. Sounds like a great spread.
Sweet time spread.
Yeah, let's nail that. That almost never worked. That was a hard one as well.
Because you'd lose in both months.
Yeah, you lose in both months inevitably, right? The move would kill you on your front and back, for that matter. Vol comes down, the back month goes back to where it usually goes, and you're like, what happened to my spread? So that never really was wonderful. I guess, here's what I'm thinking for a retail person. Okay. And again, this is an investment advice, but I think that a great spread is some kind of broken wing butterfly leaning to the side that you have some good data on direction. And if you're using vol.land or your product, Mark, at Harvested, there's some pretty good indication that this is going to be an up move based on the data. So you could do a great broken wing butterfly, right? Which is, I make the lower part of the butterfly a bigger strike difference than the upper part. So that if it blows through everything, we're going to make that difference between the two, right? So we lock in a profit way up. We might hit a honey zone based on our data with the short in the middle. And if we lose, we're going to lose what we pay for this thing, right? We already know that, right? Mm-hmm. I like the broken wing butterfly. What about you guys? You guys like that one or not so much? Or would you just do a regular butterfly?
So I mean, first of all, like the broken wing butterfly, it depends on how much it costs, but it also depends on the move you're expecting. I mean, if you go back to your calculation,
yep.
Like if you share that calculation again.
Yeah, let me show it. Hold on. I've got, go ahead. We can share my screen.
Just as a quick review, I was expecting somewhere between 500 and 525 based on vol land, right?
Right.
And if we looked at your little scratch pad, the move expectancy there is 520 to the upside, 422 to the downside.
Yep.
Which is, so if I'm expecting something within your expected move, then you don't want to be long gamma because that's the expected move. You're, paying too much. So a broken wing butterfly would, in my opinion, would work very well there.
Yep.
Maybe have it centered around the 500 area, do 30 points on the downside, 15 on the upside. You can make some money that way.
Yeah.
So I like it for that.
Yep. However, that's what I did. I think I did it wrong though. And I can move this around. So look what I did is I did the 475, 485, and then the 485, 490, this whole broken wing. Now, my thought was this, is that if it breaches way up here, okay, I've got to lock in profit to the upside, right? It's a finite number. We get it. It's the difference between the two spreads, right? Less what you pay for it. So that's not bad. I make a few $100s, and my risk is about, a little bit more than that to the downside. But again, I've made the decision because I've looked at the data and I feel an upside move is coming. Now, I guess my question is that, do we move this whole thing up, pay a little less for it, expecting the bigger 10% move, which we can do. So if I move this up to like, say the 85 line, now all of a sudden, we're at 212 for this thing versus 242 before, new dynamics. What I'm trying to do is hit the honey zone. So I'm trying to get to the short strike is what I'm trying to do. I got a benefit way, way up. And of course we're always going to lose our debit spread to the downside, right? So I'm wondering
there's a couple things I would think about on that is, first of all, it's not really worth $30. But if you want to try to land in the honey pot, which is, that's like perfection, you also have to realize there's 2 days left in this trade, right? There's today and tomorrow, and you don't know what tomorrow will bring. Tomorrow is a Jackson Hole thing. So
that's true.
You're going to have, there's going to be event vol for that too. I think the way you did it would be my preferred way, because now the honey pot is, you're guaranteed a certain amount of profit. Mm-hmm. The honey pot is like, if we see, if Jerome Powell gets up there and says, I'm raising rates only on NVDA, we're going to go down, you'll at least have some space in that honey pot to get out of the trade or, to collect some more honey pot profits, because you are now in that like super profit zone.
Yeah.
That minimum profit zone.
Yep. I like it. Yeah. I could, if you gave me the analysis last night, via email, and you were kind of predicting 500, which I think is right on the money. It's opening soon here. I think it's right on the money. So there's still a day to go, as you said. So this spread's going to have value to it. Same with the 470 straddle. That's not going to $30 and be done. There's value in that put for a day and a half. Right. So there's going to be value in that straddle too. It's going to be $30 plus something, for today. And I didn't look what normal volatility is, but it's around 60, when we get back down to it.
60.
Yeah. So 60 implied volatility, what is that going to be for that $30 out of the money put for 2 days to go? It's going to be something, right? So I could have sold a $45 straddle and it's going to be 30. It could be 38. I don't know, 37.
The other thing you could have done, you could do with a broken wing butterfly that's further below your expected area is now when we shoot up to whatever we're at now, 505, 506, you could sell that bullish side of that butterfly and have a freebie going downside if you feel that there's a threat for NVIDIA to retrace.
Oh, that's kind of cool. What do you think about that, Mark?
I mean, I love the broken wing butterfly overall, just for its like flexibility in this scenario. And like, I think in terms of like setting those points and whatnot, like this is where, as the buy side trader, you like can lean on what the market's telling you, right? If people are very good at pricing where implied vol is going to go, great, lean on that and use that to help like feed into your fundamental, technical, whatever research you're doing to complement that. Gut feel, Reddit forum, like whatever, like you've got like going, like take that straddle price, take 80% of it and set that as your tent. Like, I think let them do the vol pricing and you layer on your edge and let the market like find those right risk rewards for you.
Yep. I love it. That's good. So guess what? I think NVIDIA is trading around,
I see like 493. It's actually sold off a little bit.
Yeah. 493, 494 thereabouts. So my little butterfly at 500 is looking pretty good. We'll talk about where this baby opens next time, because I know we're running out of time. Anything else on NVIDIA? So great earnings, big move, probably going to lift the NASDAQ if all things being equal, right?
NASDAQ's up like
it's not up as much as I thought it'd be. I thought this would be a little bit more exciting. So only up about 70 points in the NASDAQ. Not too exciting.
Well, it seems to have dropped quite a bit from the open.
Yeah.
I think I saw like 515 overnight, even at one point, or maybe that was earlier this morning.
No, I saw that too, for sure.
Yeah,
for sure. All right. Well, that's all good. That was a good breakdown. I think I like that broken wing. I love the Voland. I love the harvested. We had some good data. So, I tell folks, get on these two guys' stuff, will you? It's great tools for folks to make some decisions here, man. I love it. We didn't have this ability back in the day. We just, like I said, finger in the air. Which way are we going? All right, boys. Mark, welcome back to America.
Thanks for the plug, Lex.
Yeah, of course, right. Anytime.
Ding.
Ding, ding, ding. Oh, yeah, it's my ding. All right, so we'll see you guys next week. I'll be overseas. Mark's lending me.
Are you going to France?
I'm going to France. On Friday, I'm going to Mark's, villa in France, and he's putting me up over there. And we're going to do a couple shows from France. So, hang in there, right? If Mark can do it, I can do it. I want to do it over there with that he did.
You know what the requirement is?
You're
going to be in Provence. You need a glass of rosé for the show.
Don't worry about that. I will absolutely have a glass of rosé. Awesome, boys. Well, thanks for all that. You guys have a good rest of the week. I'll talk to you from France next week, okay?
All right.
Safe travels, Lex.
Wrap it. Thank you.